had a short little presentation about some of the most common misconceptions in tax when it comes to real estate investing. Things that I've heard over and over again throughout the years. Like last year, we heard all these horror stories about Obamacare. What you typically hear are horror stories about things called recapture or basis, stuff like that. I was at a conference speaking last week that wanted me to talk about comparing real estate to other asset classes and how tax compares to those different asset classes. I walked away from that with the conclusion basically that you're still in the preeminent tax position with the asset class that's dealing with real estate today. So a lot of these things we already talked about. A lot of the tax-free nice things about real estate investing, like distributions, appreciation, refinancing, that's what we all talk about. The primary question that I get to here at the end is, what other asset class can you get a 10% cash-on-cash return with a tax loss? It's oil and gas, basically. The difference between oil and gas and real estate, though, is oil and gas is a depleting asset, whereas, real estate's an appreciating asset. You've got so much flexibility on the back end when you want to exit. You can do all kinds of different things. Most of it's all tax deferred. And again, your participation within the activity is the big key in terms of what you can do with those real estate losses.
Is this working? Great. One nice feature about investing in the LLC structure that Forum typically uses is for estate planning purposes. You can take a pretty sizable, somewhere in the neighborhood of about 30% discount when you put the asset into your estate plan. The tough part about real estate to understand is that, it typically is in a loss position. And where people get confused is you can't take losses necessarily in real estate and offset other income streams from other asset classes. It sort of lives in its own little silo. And what will happen if you're a passive investor that's not actively involved in the day-to-day management of the real estate activities, you create what we call suspended losses. And there's a misconception that they expire and they go away and they're never used, but they always get freed up and they're always used on an exit. Another common myth is something we call basis, and I've got an example in here. And from a pure management perspective, a manager that the portfolio over frequently is preferable from a tax position to someone that just sits on their portfolio. And the reason why is you'll build up these suspended losses and you won't derive the tax benefit from year to year to year unless you exit these positions. So as you roll the portfolio, you're a much more tax efficient real estate investor typically. This goes through suspended losses work. I'm not going to spend a lot of time here, but it's in your informational material. It's very simple, very basic. Down at the bottom, I've just got an example of a client that last year that really had a large suspended loss. We got him out of the business, but then he freed up a whole bunch of suspended losses and paid no tax that year. Basis, this is a very simple example. Two investors that put in 100 to, but it creates deduct further real estate losses. Last year, Obamacare was really the loan thing that came out. When it originally came out, everyone thought that it was interesting, but as we've had 1 year to really think it all, at the end of the day, I think perspective, very low level, although but that doesn't affect form. Does so under the normal fact pattern, you're throwing off losses. You're just not subject to Obamacare. Where it does matter is when you exit a real estate position. That's when you create all this rental or real estate income, and now that's when the Obamacare window would typically open up. But again, it's only applicable to passive investors. If you're an active investor, you don't need to worry about it. The nice thing about real estate losses for Obamacare is if you can use those losses, you can actually offset other passive income like interest and dividends, and it'll reduce your Obamacare tax. Last year I got into the real estate professional status. I don't want to go there. This year is extremely complicated, but it's basically gets you around a lot of different things. Obamacare gets you into a lower tax position, allows you to deduct losses in full and offset it against other categories of income. So we call it tax nirvana. I've got some charts in here. I'm not going to get into a lot of this detail, but what I'm trying to do is just compare real estate income to other forms of income. And the two big things that I hear a lot are these recapture things, especially when someone wants to unwind their real estate position. They think they're going to get clobbered with recapture. However, that's not necessarily the case usually, and I've got some examples here, but hopefully we'll dispel that. What I've done here is compare real estate income to other forms of income and how they really shake out from a tax perspective only. Again, if you spend the time to sift through this, you'll find that real estate income is pretty preferable to all of the asset classes. All right, and then this is a real-world example of a deal that I was working on recently. It's a $10 million acquisition with a 6% cap rate and 11% cash-on-cash return. Another confusing thing that investors deal with are K-1s every year. They don't know what any of the numbers represent. They don't know, where they come from. How does that get from a financial perspective to tax K-1 reporting, and how does it impact them? But what I've done here is gone through a very super simple example. Here we have the normal fact pattern where we've got cash flow every year, and then due to the depreciation benefits, we actually create tax losses. So, we've got the optimal scenario where we're walking away with cash, we've got no tax to pay. Then I come along in year 2 and I unwind this entire position. So what happened here is we bought a building for $10 million, and it's split between the land and the building and some personal property. And then for 2 years, we had $614,000 of depreciation, which is the sum of these two numbers here. So what that does is it reduces our basis and increases the gain on the sale of the property. And in this case, over a 2-year period of time, I'm just using hypothetical 25% appreciation. So I've got $3 million a gain. And when people think about that, they go, oh my God, I'm going to be paying 39.6% plus another 3.8% for Obamacare. And then my itemized deductions are going to phase out, and next thing you know, when I layer on all the state taxes, I'm paying 50%. But that's never usually the case. What happens here is I break out my recapture. Most of this transaction is a capital gain, and the overall effective tax rate on this disposition is 20.6%. So from a tax perspective, it's very favorable. That's without Obamacare. So if you're passive, you would add on another 3.8%. In this particular fact pattern, another thing that I typically see is confusion when it comes to leverage. And then it all unwinds itself, and they get a K1, and they're not really sure what happens. But in this case, there's 119% return on equity, even though I've only got a 25% appreciation in the underlying property. But that's all due to leverage. And then what I do here is I just walk through how those numbers actually hit your K1, and you'll see examples here how they actually flow through. So when I wrap up, what you really want to understand when you talk to your CPA about what are the consequences of real estate investing from a tax perspective. There's a lot of exit strategies. Recently we've gotten out of a couple of foreign positions, like 29 North. There was every conceivable combination. We had people being cashed out, people that rolled over, people that did drops and swaps, people that did hybrids or some combinations thereof. There's a lot of flexibility in the back end. You also need to know, the key is when you're an investor is your CPA has to understand what your involvement is. Not only in that particular investment, but in its entirety. Last year there were some very favorable repair regulations, we call it, but you don't see that on your K1, you don't see it anywhere. But if foreign did any rehab work, it's a very favorable now tax ruling where basically the dollars that they spend on new CapEx can pretty much be written off in the year that they're placed into service. And then we always have issues when it comes to state withholding. Make sure they understand that, how that works with your resident state return, and are you really in compliance with all your state filings or not?
Excuse me. So on all this repair work and stuff, special treatment, that's all handled before our K1 already takes that into account. So
That's
we're not worried about that.
That's right.
Is that repair treatment for multifamily only, or is it for all commercial estate?
No, it deals actually with far more than even multifamily. It's all real estate, all asset classes really, that invest and renovate property. In fact, I did not to go too far off topic, but a client of ours that spent $40,000 in rehab dollars per unit was able to write off 80% of the original acquisition cost of the building. So again, another scenario where he didn't pay any taxes for a while. Yeah, big tax favorable ruling. So I just put this in here at the end too. Just keep in mind that real estate tax is a somewhat nuanced area, and it's got a very high rate of non-compliance. So just keep that in mind.